All right, guys, we know the Fed looms over this market. Our very own Peter Barnes sat down for an exclusive chat with New York Fed President William Dudley. Take a listen.
I think we're looking for growth in the second half of the year that will be stronger than the first half, so some acceleration in the growth outlook. The labor market continues to generate reasonable job gains. We've 190,000 in the last 3 months. So I think, we're edging closer towards, the point in time where it will be appropriate, I think, to raise interest rates further.
On that interview, the dollar quickly trimmed earlier losses after investors heard it. Here to react, former SEC Chairman Harvey Pitt. Harvey, thanks for joining us. The Federal Reserve, it's always interesting when a dove sounds more hawkish. But what William Dudley was saying with respect to the jobs market is one thing, but as far as wages are concerned and the overall GDP, still lagging tremendously.
Absolutely. The economy is performing substandardly, and this is a very, very slow recovery, despite the administration's efforts to pose it as something more robust.
Do you think also the Federal Reserve has a vested interest and sort of being able to justify their existence and the extraordinary actions that they took to at some point take a victory lap themselves, even if it may not seem justified to insiders who know the real deal?
Well, I think there's a lot going on with respect to that. I think the Federal Reserve Board has become less independent since Dodd-Frank has been enacted and since the economic meltdown. And as a result, they're part of the administration's policy apparatus, which was never the role the Fed was intended to perform. The Fed was always supposed to be an independent setter of monetary policy, but we're seeing comments and actions from the Fed that look much more like part of the political administration policy.
And to that point, I'm glad you brought it up, because I also see where the Fed has a dual mandate, but when they speak or when they take action or inaction, they talk about the economy in China or the British exit vote or things that maybe you could connect the dots, but they, I don't think that was what their initial role was supposed to be, and it feels like they can use that for an excuse anytime they want to do or implement policies they may or may not want to.
Yes, we're looking, it seems to me, at policy that is being set and then justifications are attempted to be found after the fact, as opposed to trying to help the country get on an economic recovery track, which is what their job is.
So having said that, we've got a couple of things here. You got the credibility, and of course, the ability to be able to jawbone markets is a key asset for the Fed, but also, what kind of danger are they putting us in if they continue to keep rates this low for so long, particularly after all of the money they printed up?
It strikes me that this is going to produce a very dramatic and adverse market reaction when they finally get around to allowing rates to rise. I think what we've seen right now has been very artificial, and instead of letting the economy function, they are basically fueling short-termism and keeping people focused on day-in and day-out events as opposed to the longer term, all of which bodes poorly for the stock market coming down the road.
Harvey Pitt, thank you very much. Really appreciate it.
My pleasure.